This is episode 25, if you could believe it, Pat, of Greenstream, where logic meets life and investing. It's Pat Collins, Greenspring Advisor CEO. I'm Mark Schaefer, our Director of Growth. Today's episode is going to be about, is this the best that you can do relating to index funds? Let me tell a quick story about why I think this is super, super important. So Winston Lord, an ambassador, he was writing a report for Henry Kissinger, who was the former Secretary of State for the U.S. And he wrote this report. He spent a few days on it, and he gave it to Henry Kissinger, and he got a note back from Henry Kissinger, and it said, is this the best that you could do? So obviously, nobody likes to get that, so they go back and they rework it. He got the same note again. And so he did it one more time. He gets the same note for the third time, and he goes to Henry Kissinger, and he says, yes, damn it, this is the best that I could do. And then Henry Kissinger says, okay, I'll read it then. And I love that story because I think every profession, we should be focusing on that. For us, this is really relevant because we think about this all the time. Is indexing the best that you could do? What's the cost? What's the limitations? What's the intents? What's the implementation? So that's what we'll talk about today, is indexing, the best that you could do, and we'll kind of dive in. How's that sound?
It sounds great. I love the story. Happy New Year to everybody. Assuming this will be coming out here slightly after the new year. One thing I'll mention before we kind of dive into this, I'm excited about this episode because I actually think that the index fund, which seems pretty basic to a lot of people, I think is probably one of the most important innovations in personal finance over the last, say, 50 years or so. If you look at the amount of fees that have been saved by investors that have been moving into index funds compared to maybe their alternatives that we'll get into in this episode is staggering. And if you look at the amount of flows, new money that's coming into this industry, so much of it has been moving into index funds through companies like Vanguard. So I do think this is a really important topic. There's lots of money moving into this space. There's lots of money that already exists in this space. And the idea that, can we do any better than an index fund, is a really important discussion because there's so much money in index funds. So I'm excited to get started.
Yeah, I think that's an astute point. When index funds first launched, I think it was AllianceBernstein called them like anti-American was the phrase, right? This idea that average is the best that you could do. And it kind of misses the point that no, average is better than what you could do. And the whole reason why we're having this conversation is because indexing has been popular. Why has it been popular? Because the performance has backed up the promise. If you kind of go back to maybe the beginning of index funds, it's like the 70s, right? And one of the things that they were trying to do is, at first, they weren't trying to build investment vehicles. They were just trying to figure out how well is active managers doing, right? It was simply a performance measurement tool. But in order to measure something, you have to figure out, what are we measuring it against? So they came up with this idea of an index fund, which is, well, for the most part, let's just build a very rudimentary group of stocks, and then we can judge all the asset managers against that rudimentary group of stocks. And that's kind of how the index funds got started.
If anybody wants to read a really fascinating book, there's a book called Trillions, and it's about the first index funds and how they came about and whatnot. And so maybe fascinating for us. I'm not sure if our listeners would be interested in it, but I found it fascinating. Lots of different tentacles going into different academia, companies, how they all came together to form these first index funds. But I think it's important to understand what the goal of an index fund is. I think a lot of people might think, well, the goal of an index fund is to make money, hopefully, for their investors over time. And that's not really accurate. The goal of an index fund is to track an index, plain and simple. So if the index goes up 10%, the index fund's goal is to go up 10%. If an index goes down 25%, the goal of that fund is to go down 25%. It's a lot different than other investment vehicles when you think about what their kind of stated objectives are oftentimes. Usually it's either to outperform an index, sometimes it's relative to an index, sometimes it's just actually we want to get positive returns in any market environment. You see that out of some vehicles sometimes. So it is a little bit different from the standpoint of what the goals are. And that creates some challenges when it comes to implementation and structural things that I think we're going to get into. But that's, I think, probably an important premise of the whole episode is kind of keep coming back to is that the goal of an index fund is to track an index. And so maybe we can dive into some of the, some of the kind of nuances of that, in the episode here.
Yeah, I think that's absolutely well said. The goal is to, they call that tracking error, how to get tight tracking error, whatever your index is, you want to get as close to it as possible. The result has been better performance than active management, but that's not the goal. And kind of what you described right there is the publisher tracker relationship. So in index funds, a lot of times there's kind of an independent company that's publishing this group of stocks. And then there's somebody out there that's saying, okay, well, what I'm going to do is I'm going to build a real live portfolio. This is simulated. I'm going to build a real live portfolio and I'm going to track this group of stocks as closely as possible. And the way you're going to judge me as an investor is how well do I do that? The first thing I'll say is I think this should be cautionary because anytime you're looking at performance, this is kind of like a hidden secret almost. Are you looking at the live fund that's being tracked, that performance, or are you looking at an index performance? Because an index performance can be backdated. It can be backtested. Well, if you would have invested this way in 1970, here's what the performance would have been. If you would have invested this way through 2008, here's what the performance would have been. And there's a host of errors that go into kind of some of these more exotic back tests. So the first thing I'd say is you just want to make sure anytime things are kind of getting exotic that you understand, hey, am I looking at something that's real, that's live, that's in the market, or am I looking at something that never really existed? And then that kind of leads to, I mentioned this exotic. A lot of times index funds are associated with really amazing characteristics. They're super low cost. They're highly diversified. They're very transparent. They're really efficient when it comes to tax efficiency. That's not true for all indexes. And not all indexes have to be great. There's over 3 million different indexes out there in the world today. And so it's no longer just a truism. If it's an index, it's good. If it's active, it's bad. There's kind of this blending of the worlds. When I started at my last company, which we were an investment manager, there was an S&P 500 index in our HSA, health savings account. It was 50 basis points. This is 2014, right? Like, just because it's an index, it doesn't mean it's that much better. And since the world's gotten a lot cleaner.
Yeah, I think one of the most important aspects of the index fund, the advent of it and what's been happening over the past 50 years is just the lowering of fees on these products. If these products were 1%, 2% kind of fee, like I don't think anybody would be talking about the index fund as much as they are today when you can buy an index fund for a few basis points, meaning 0.01 or 2% or 3%. And so, really it's essentially gone to almost zero, the cost to buy, an index fund, which I think is important. But there's another element we've been talking about, these terms, active management and passive management. And I think it's worth taking a minute to understand kind of what we're talking about here. On the active side, I think most people get this. This is managers that are trying to, typically their goal is to outperform, and it's some sort of benchmark or to have absolute performance or something like that. And so they're buying and selling securities. They're trying to time the market. They're trying to read the tea leaves, if you will. The other side of it, I think a lot of people think is passive management is an index fund. But I think what we're going to talk about here for a few minutes is that it's not really passive. There are a lot of decisions that go into deciding what kind of goes into an index fund. What stocks do they exclude? What do they not exclude? What size companies are they putting in there? How do they decide which company gets added? What company comes out of an index fund? There's all of these decisions that at face value, if you kind of look at it, you would say that sounds like active management decisions. So, a true passive fund would literally mean just buying every stock that's out there based on its market cap weight. That's typically what I think most people would consider. And there's very little of that going on with index funds. There are kind of changes at the margin, depending on which index you choose, depending on which markets you're in, depending on exclusions. So maybe we could start there with some of these structural decisions that are happening within index funds. Maybe you can kind of get into some of those items.
Yeah. You bring up this this great point. Even passive is an active decision because you have to decide, well, what index fund am I going to buy? And then the moment you're making that decision, you have to unpack what exactly are these index funds doing. The area of the market where there's more certainty about what that is anytime there's less decisions being made. So what you're talking about is, hey, if you say, go out there and I want to buy just the whole US stock market, there's still decisions being made. You got to decide, okay, I can't buy the very smallest companies. So what are some of those decisions? But the tracking error, the difference of performance between this very kind of established, the easiest decision you can make is still between 5 and 10 basis points per year before taxes. And there's some tax implications. And at first you're like, well, that's not a really big difference. But you have to consider what you said earlier, which is now fees are very close to zero. So we're actually talking 2 or 3 times the fee is the result of how do you pick which one of these indexes to track. And then the more you deviate from that very simple decision, the more differences you see amongst indexes. So yeah, let's get into what are some of those differences.
To just expand upon that last comment, I think it's a really important one because what I tend to see with index investors is they're so fee conscious. And rightfully so. It's a really, really important decision when you're investing is what are the fees. But it's a great point that just picking an index fund solely based on fees may not be the best way to approach it, given that in the case of just a US total stock market fund, you could have 3 times the difference in performance, not based on fees, but based on which index that you choose. So hopefully this episode is going to give you a little bit of ammunition to start thinking about if I am an index and fund investor, how do I select which indexes? What are some of the things I should be looking at? But I think we're also going to get into, are there alternatives that can enhance what the index fund investment experience looks like based on maybe some of the shortcomings we're going to get into that are inherent with index funds. So yeah, let's start talking about some of these kind of structural decisions.
I just want to talk about fees. We think investors are rational and they're going to buy the cheapest thing, but there's this, it's not technically an ETF. They're trying to change that. QQQ, one of the largest investment vehicles out there, there is actually a cheaper version run by the same people that tracks the exact same published packet of stocks, except it does it better because it's cheaper. But people still buy QQQ. It's not just a truism, right? So I think maybe one takeaway is, hey, even if you really like something, and I think there's reasons why you might not like some of the arbitrary rules that go into QQQ, but even if you like something, there might be a cheaper way to get exactly what you like. So there is still a little this kind of business branding kind of marketing going on. But, if we take the US large cap, maybe I'll talk about QQQ, some of the subjective decisions in that. So that's the NASDAQ 100. It takes the 100 largest companies on the NASDAQ stock exchange. So right there, it's telling you, hey, this is kind of a marketing vehicle for the NASDAQ. there's other stock exchanges in America that have other great companies on them that would be eligible, except it's a promotionary product for an exchange. They exclude non-financial companies. That decision was made in 1985, so take it for what it's worth. And then there's also some concentration limits because it's kind of an arbitrary discussion. So right there, you might say, wow, look at all those decisions that are being made, that there might be a better way to get the underlying exposure. If you think about the S&P 500, well, is it just the largest 500 stocks in America? It's not. It's the largest 500 stocks that have 4 quarters of profitability and are granted approval from some committee. Do we know who's on the committee? Do we know exactly how they make decisions? We don't. We can infer, and the market does a very good job of inferring, but it's not even a truism. So right there, the two, I think, most common indexes out there have some subjective rules that if you're really trying to fine-tune allocation are worth considering. Why do I not want the 501st largest company? Why do I not want the 101st largest non-financial company on the NASDAQ stock exchange?
Yeah, it's fascinating. And we're talking about large U.S. liquid companies that I think there's kind of lots of, I think most people would have said, yeah, S&P 500, it's kind of almost a afterthought that it is the 500 largest companies. In fact, it's not. I think where it really gets interesting and where there's divergence is when you get into other markets. So small companies, international companies, emerging market companies. Maybe talk a little bit about the differences in indexes on some of those, because you can see pretty big performance discrepancies based on which international index you decide to invest in, for example. So I think it's important to understand, like, how do you think about those things? How are the index providers developing their indexes? What are some of the kind of the metrics that they're looking at that could cause pretty big differences in say, small cap index A and small cap index B?
So like we mentioned in the US for kind of total market solutions, probably 5 or 10 basis points, that's 0.05 to 0.1% difference kind of per year. Outside the US, you're probably looking at 1 to 3% difference depending on 2 strategies that you're selecting to cover similar types of exposure. So why do you see those differences? You might see those differences because of the different countries that they're selecting and how they're being decided to be eligible. You might see those differences depending on how deep into the market, the breadth of the exposure they're able to go. So is it just a large cap index or is it small caps? And a lot of that, by the way, is dependent on, hey, how have these products evolved over time? Where a lot of the newer solutions, or if you change an index, which is something you could do, they have the ability to go smaller. It's decisions like, okay, well, let's say 2 indexes both have added an eligible country. They might not determine that the weights should be the same because there might be some currency issues. There's all sorts of different things that it seems like at face value, well, hey, we'll just buy whatever the market is, but determining what is the eligible market is subjective. And then these publishers and these index trackers, they're going to have to go back and figure out the impacts on their constituents. So if a country was emerging markets and they think it's now developed, well, they got to go understand, hey, how much of our other investors really care if we make that change, even if it's the right thing to do. And by the way, we might care a lot because it might be, hey, that might be a tax hit. It might be, well, I actually have exposure in this other country. So if you make that change, I'm going to double up on my exposure. So there's all these other stakeholders that are involved in investing that kind of create this instance where I don't think you're ever going to kind of see agreement on what exactly is the market that should be tracked.
Yeah, and there's probably not a right or wrong answer here to say this is the best index for international or this is the best index for small cap. You just have to understand as an investor what you're buying. So if I'm investing and I'm thinking that I'm buying a total market fund because I'm buying an index, let's say, of international stocks, but I'm only getting the 100 largest stocks in Europe, for example, maybe that's not what I thought I was getting, basically. So I think it's important that you basically pop the hood and you look at the indexes that you own, if you do own index funds, and figure out, is this what I thought I was getting? Am I getting the exposure that I want to? Are they excluding the countries that I would hope they would exclude or not excluding? So there's lots of factors that go into it. And it's pretty fascinating that, two indexes that are tracking the same asset class could have 1 to 3% difference per year. That's pretty significant. And when you're talking about, people worried more about fees and things like that, I think it's worth considering as an investor why is there the discrepancy between index fund A and B? And obviously that's something we're doing a lot of here at Greenspring, is trying to understand the different index providers and what makes sense and what doesn't. If we maybe move into some of the implementation items, I guess I would call them, of an index fund. This is where I think when we start going down this path, you start to see some of the shortcomings of an index fund. So maybe let's take a few minutes to talk about, what are some of the downsides of an index fund? I think we've talked about all the positives, and yes, there's some discrepancies in performance based on how they're constituted. That's just kind of a function of which index you choose, but you get broad diversification, you get low fees, kind of what's not to like. Maybe let's talk a little about some of the issues with index funds. So maybe let's start on kind of the implementation items.
Yeah. To what you raised, it's not a right or wrong decision, but I do think it's incrementally better and it's incrementally worse. And you can incrementally improve outcomes and you can incrementally create hurdles for performance. So if you think about your instance, right, you're kind of buying a mass produced product and you're trying to figure out, is this mass produced product the best fit for me? Or is it maybe the best fit for somebody else's situation that doesn't really apply to me? So the more this matters is the more you deviate from the market. So US kind of total market, 5 to 10 basis points, international, 100 to 300 basis points. Once you get into like small cap and small cap value, 400 to 500 basis points per year difference. And as we know with every investment disclosure out there, right, past performance is not indicative of future results. What does that mean? It means you can't just use last year's performance to help you determine what the better index is. So you got to pop the hood. You got to look at these things. One of the big things for a lot of the clients that we work with is tax efficiency. And one of the big components of that is, hey, should you include real estate in your index fund as an equity, or should you have it as a standalone asset class? That singular decision might be 5 basis points of tax advantage on any given year. So right there, again, if you're a US total market portfolio, and you could mathematically estimate this, right? You could say, hey, here's the expected dividends from real estate. They're 2 or 3% of the portfolio. What would happen if I excluded them? And if you're in the highest marginal federal bracket, yeah, it's 5 basis points on strategies that charge 3 basis points. That's a decision. Real estate companies tend to be more small, so it might be even bigger there. It might be 10 or 20 basis points. So those are all decisions around how are you constructing an index that if you're an institutional investor and you don't pay taxes, you don't care, right? You're indifferent and you're saying, hey, I actually care more about this tracking. Whereas if you're an individual investor and you're thinking about investing in a taxable account, you might care.
Yeah, absolutely. I think if we go back to the goal of an index fund, it is to track an index. And so how do they do that? Obviously, the index providers are coming out with, here are the 500 stocks in the S&P 500. When we change it, here's the date that we change it. Remember, if you're an index fund, you have to be trading the exact same time that the index is moving something in or out of that index. So there's kind of an immediacy to trading that does kind of create some hurdles for an index fund. And, I'll use just a few examples. And it's true in the stock market as it is in a lot of parts of our lives that when you demand immediacy, and everybody wants something at the same time, prices tend to go up. You see that with like airline tickets. You see that with hotel rooms. You see that with concerts. You see that with Ubers, trying to go get an Uber, and everybody wants to buy get an Uber to go home at a certain time. So we see that in stocks too. If everybody wants to buy a stock at the same time, it can drive the price up. And if everybody wants to sell a stock at the same time, it can drive the price down. So you think now back on the index funds. Index funds are publishing at some level a reconstitution, meaning when they say we're adding or taking names out of the portfolio, stocks out of the portfolio, everybody to meet that goal of an index fund to match the performance have to buy or sell at the exact same time. And that creates some problems. So maybe talk a little about, I've seen some research on this, but to me, it's pretty fascinating when everybody is buying and selling at the same time, what that does to the price of those. It may not be every security in the portfolio. It might just be a few securities, but what happens when that occurs inside of an index fund?
The whole reason people like indexes is because they're transparent, right? So you could say, hey, here's the rule book. The person publishing the index says, here's the rule book you have to follow. And then at some point in time, your portfolio is going to change. And the market is very good at saying, okay, either the index publisher will tell them directly, or the market will infer and say, well, I know this company has had 4 straight quarters of profitability and it's pretty big, so it's going to be added to the index. So this tends to happen once a year, once a quarter, once a month, and the indexes are kind of rebalancing their portfolios. They're giving, at least the market can really see in advance, we can see from the data, 20 days, which is about a month, to 5 days before something gets added or kicked out of an index. They're telling, the market knows. We know that this company is going to get kicked out and this company is going to be added. And so what the market does is it takes the other side of that trade. And when you say there's a lot of demand in one moment, you really mean 4 p.m. on the day that happens. And so you see volatility spike and volume spike at 4 p.m. on that day. And so leading up to it, there's typically the security being added. It will have a price increase. That's what the research shows, about 4%. Let me just break down exactly what that means. So if you're in an index, you don't hold this name. It just got 4% more expensive. After it's added in the next 5 to 20 days, it gets a little bit less expensive. In some cases, these are 10% swings. I didn't get the price increase, but I got the price decrease the moment I bought it. That's a good trade for the counterparty. That's not a great trade for you. To your point, sometimes these are relatively minor parts of the portfolio, right? The S&P 500 isn't doing this with 100 stocks every single year. But if you're in small caps, you are doing it with hundreds of stocks every single year. So the impacts can be a little bit bigger. Tesla is a great example of kind of one of these companies that it was very large. I think when it was added to the S&P 500, it was a top 70, maybe a top 7. I can't remember exactly what it was, but it's one of these top companies because its market cap is so high. But it never had profits as defined by the S&P committee until this time. They had to make special rules because it was such a big addition. It's kind of pretty rare that this happens. But you saw like they gave a 40-day advance notice. The price increased crazy amounts over that time. Just the last week, it went up 13% before it was added. And you just see volume spike. And then right after it's added, what do you see? You see a price decline. So these are definitely, it's quantifiable. It's out there in the research. Everybody knows that this is happening. The hidden secret is, as long as you're tracking your index, how much does it really matter? Because you're delivering on your stated goal, which is the perspective of the index providers. And they're absolutely working on ways to try to diminish some of this at the margins. But the truth is they can't, because there's just so much money tracking them.
It's fascinating to me that if you were an index fund manager and Tesla gets announced 40 days, and the index provider basically says, in 40 days, we're going to add Tesla to your portfolio. And you watch it go up 14% over the next 40 days, knowing I got to buy it in 40 days, and it just keeps on going higher. And then I buy it, and then it drops basically after that. That is to me, that's a very frustrating thing, obviously, in the pursuit of the goal of tracking the index exactly correctly. I know that there's even counterparties, hedge funds, that part of their entire strategy is just taking the other side of these trades. And it's brilliant to a large extent. You can basically buy stocks that you know are going to get added well ahead of time. You watch the price run up, and then you sell them after they get added. And that's exactly the reasons you're talking about, is why things are going up and down, is that the market's not dumb. The market's figuring this stuff out and saying, we can make money in this. We're going to provide liquidity basically for these index funds. So I think it's probably one of the bigger downsides of an index is this kind of immediacy that takes place with trading that causes some of this price underperformance. And to an outsider, you probably don't see it because, again, to your point, the same thing that's happening to the index fund from a performance standpoint is happening to the index itself. So you look at it and you just say, oh, that's what the index returned. What you don't realize is that it could have been better had you not had to trade on that specific day, most likely.
Exactly. Yeah. And if you put yourself in the role of the different stakeholders right there, the index manager, let's say you bought Tesla early and you outperform. That doesn't look good because you did something different. And there would have been a risk that, I don't know, there's a battery fire and there's a big recall and the stock goes down. And now you don't take that type of risk when you're following a rule book. And those hedge funds, yeah, there's a risk because they're really levering up to milk those profit margins. But what happens if there's a big event? Like they're taking some of that risk. There was another instance, I think this was the summer of 2023, where it's kind of right at the beginning of the AI boom, and NASDAQ has some concentration controls. The NASDAQ 100 is like QQQ. And as a result of these concentration controls, they had too much in a few names. And so there's a rule book, right? Hey, when you have too much in a few names, here's what we're going to do. We're going to tell everybody we have to do a special rebalance. I think it was the day before my birthday. It must have been July 23rd. And what happened is $200 billion traded hands, where they sold, hey, they are market cap weighted, which we think is a good starting point. And they had to sell some of their top concentration. And there was the same thing that happened. There was a price run up and there was a price decrease. And if you would have delayed your decision by 5 days, the result would have been 40 basis points, 0.4%. QQQ, which is the expensive version of the two options I talked about, its fees are about 20 basis points. So 2 years of annual fees kind of gone. It's just the cogs of the machine working, and there's kind of nothing that you could do. And obviously, absolute performance has been great for those types of companies, but it doesn't mean that the design, there aren't opportunities to try and think about improving the design.
Yeah. And I think this whole reconstitution that you're talking about, this rebalancing of the portfolio with new names and old names, or names coming out, I think the other part of that is detrimental to investors is what a term we call style drift, which is meaning basically that the stocks that I own aren't matching what I thought the strategy was inside the portfolio. It's like you see this a lot with active managers where a large cap manager trying to get higher returns may end up buying 10% of the portfolio in mid cap stocks. And maybe he's successful, maybe he's not. But as an investor, personally, I bought that fund because I wanted exposure to large cap stocks. Maybe I already had a mid cap fund that I had exposure to mid caps in. So that's the problem with this style drift. And it's happening with index funds too. So maybe talk a little bit about, what we've seen with the style drift component of index funds, which doesn't seem like it should exist. Index funds should be tracking a specific asset class, but based on how often they rebalance, it's actually not the case. So maybe talk a little bit about that.
Yeah, I mean, it's if you do it once a year, then the day after you do it, you're going to look exactly like what you intended. And 363 days later, you are going to look not like you intended. And to me, the wild thing about some of this is that's just how it shakes out, right? Here's the rules. We're going to follow the rules. But what's wild about it is if there's cash flows going into that portfolio, let's say you want a small cap portfolio and a company shoots up in size and there's $100 going in. Well, you're going to go off the rules that were established when you rebalanced last year. So this company that's a large cap, it's going to get the more than it should in terms of inflows. It's like the opposite idea, right? Hey, I want to buy a small cap portfolio, so let me give you some money to buy some small caps, and the performance looks great because this company has shot up in price, right? That doesn't hurt your performance. And then what do you know? You don't get quite the same performance. So hey, I'm going to take my money out. So what are they going to sell? They're going to sell pro rata, which means a piece of every stock according to the rules when they last rebalanced. Well, so what's that mean? That means they're going to sell a lot of your small cap stocks. And part of this has been the ecosystem that I think is kind of evolving over time. And hopefully we see developments, and we're starting to see developments where there's more flexible rules where somebody could say, well, hey, for money coming in, buy the small stuff. For money going out, sell the large stuff. And we are starting to see some of that, but this is like the next level that's is just really, really tough to unpack in these rule books, which are like 80 pages. And, you expect somebody buying this to try to do the research on it.
So maybe kind of the next phase of this discussion should get into like, okay, we've talked a little bit about some of the how index are constituted, some of the downsides of index funds, but specifically around the trading aspects of them. But what could we do as investors, knowing this information? I'll just say that Greenspring's kind of approach is we love kind of the basic framework of an index fund, which is low cost, diversified, broad exposure. But we want to fix these kind of issues that are, I would say, stem from lack of flexibility of having to track exactly with an index. So there are companies out there and managers that have basically taken the index fund approach and built in flexibility to be able to do exactly what you're talking about, which is to not force immediacy on trading. And we believe that's probably the next level in kind of this, in the evolution of index funds, of kind of making sure that we, get all the great things that index fund provides and try to fix or solve the downsides of some of these things that we just mentioned.
Yeah. It's how do you try to improve the idea? I would go back. We kind of opened up with this. You have the publisher tracker relationship. What you're starting to see is maybe more coordination between the publishers and the trackers. So you're starting to see not only more coordination, but consolidation. Hey, I'm just going to publish and track myself, and I'm going to build rules and systems and deal with all the nuances that come with that. You're starting to see that, which is kind of the approach that we think about. It requires more diligence, though, because the great thing about a publisher-tracker relationship, there is a rule book, and you could just sit down and you can read the rule book, and then it's very easy to monitor performance. One of the major takeaways is sometimes there's nothing you could do about these costs. There is just a cost to invest. And so you're left with, Marcus, Pat, like, I see these costs in index funds. How can I avoid them inside my 401k? It's like, well, you might not be able to. You might have a limited opportunity set, and there's good reasons why index funds would be the option inside a 401k. So you might just say, this is the best I could do in this scenario. Glad I was educated. Inside of that, though, there's maybe some other things you could think about. You could think about less funds tends to be better than more funds, right? If you have one US market fund, that's probably a better solution than, hey, let me break it down into US large caps and US small caps and US small value. That tends to be better unless you're adjusting those weights, and maybe that's a future episode, how you should think about that. You should probably think about less managers compared to more managers. And the reason is different managers, that's the tracker, they're going to follow different publishers, that's the index. And if you're following different indexes, there's a chance of a lot of overlap. If you look at Russell Value and Russell Growth, there's overlap between those two anyways. But if you are segmenting your portfolio, you probably don't want overlap. And if you do want it, or you're okay with it, you definitely need to know about it, right? One of the worst things you could do is buy twice as much of something. Example would be South Korea. Some publishers, they call it emerging markets. Some publishers call it developed markets. But if you have portfolios from two different ones, you doubled your weight in South Korea unintentionally, and doing stuff in finance unintentionally is not the way to go.
I talked a little bit about a couple things I just maybe leave with. One is this kind of, I mentioned a continuum prior to the episode. I liked how you put it. You put it more of like, this is like more of like a mountain kind of thing, where on the very bottom of the mountain, we have these, what we would say, suboptimal funds from lots of different perspectives. They're high fees, they trade a lot, they're concentrated. These are the funds that we just say you should just avoid them. And as you move up the mountain to the peak, we think that you eventually get to index funds where you get very consistent performance, diversified, there's very low costs. And then the peak is probably what we've been talking about, which is just trying to slightly improve the performance of index funds by structurally changing the way that you go about trading and implementing those funds. So I think that's just hopefully useful if you're looking at your portfolio and you're like, where am I on the mountain basically with my funds? Am I like, halfway up the mountain? Some of my funds are, at the very bottom of the mountain. Some of them are at the top. I think it's the ideal scenario is obviously you have all of your funds at the top of the mountain kind of thing, using that analogy. I think the kind of the next phase to start thinking about, and some of this will probably have to be in a future episode. We talked about how we think maybe the low-hanging fruit is just improving upon the implementation of an index fund. Then the next phase is, as an investor, is, do I deviate at all from, say, the market, if you will? And the market being just owning every stock in weights basically equal to their market cap. So I own, whatever it is, 5% of NVIDIA and 4% of Apple and whatnot, whatever the market weights are. Shouldn't you do that as an investor? That's the next phase. And obviously then you start to deviate pretty significantly from an index type of approach. But is there value to do that? And we have some strong feelings there that we can certainly talk about. I think we've mentioned it in prior podcasts, but it's something that I think we could come back to talk about. Is there improvements you can even make to just a market cap weighted fund, and what are the trade-offs?
Yeah. And it's every investor is an active investor. And the question is to what extent? The question is it based upon evidence or based upon belief? Hope springs eternal. So how do you also find the line between what's pushing what you could get from markets based upon your beliefs. And I think drawing that line is super, super important for investors to understand. Hey, here's the limits of how active I am willing to be, because there is always somebody out there promising a new widget. There's always out there somebody developing a new widget. I think one other thing is that I would take away is we are in these investment vehicles for a really long time. And we know this because we see our clients' portfolios that have stuff that they bought 20, 30, 40 years ago, right? We see prospects come in, and it might not have been the intention. Hey, I'm going to buy this for 20, 30, 40 years. But that's definitely the result. Why is that the result? A lot of times it's taxes. It could be that's the one thing that happened to do well. And our approach is that decision and what you buy should be based a little bit more on innovation, right? Hey, I'm buying this strategy or this manager because I am trusting them to innovate over time as a result of my decisions. One thing that kind of frustrates me sometimes about index funds is when companies deliver exactly what they say they're going to deliver, and just the rules of the game change a little bit. There's a really big emerging markets strategy, has like $60 billion in it, probably more. And the fees are like twice as much as the next cheapest option in the space. Why are the fees so high? Well, they built the index. It was one of the first indexes. Everybody, hey, this is a great thing. And instead of improving upon the design of that index, they said, we'll just launch a new one. And we'll charge half the fees or a third of the fees. We'll charge way lower fees. So figuring out, are there types of managers that don't close funds as often? Are there types of managers that try to innovate inside their solutions as often? Those are other things that hopefully investors can think about.
Yeah, I totally agree. I think, just maybe one closing comment is that if you have just a couple takeaways from this. One is, if you're in index funds, you're near the peak. Like, you've done a very good job. We think that, are there improvements you could make? Yes. But is it massively going to change your performance? Probably not. You mentioned, if you're in an index fund, in the US at least, 5 or 10 basis points. It matters. Like that, you should try to fight for every basis point that you can as an investor. It's, that's it's your right. But it's a lot different than if you are in an active fund that you're paying 2% on. So one is great if you're an index fund. Two, I'd say the other takeaway is understand the limitations and some of the issues related to index funds. And if you can solve them, that's just some of the incremental benefits that you can make, from an investment standpoint. We think that's important. So we're happy to, if you have questions on this, it can get pretty complex. I would say if you're a listener, you want a second opinion or whatnot, we're happy to help look at things for you, give you our take on the indexes that you might be in or how to make improvements upon it.
Yes. You could tell from this conversation, I got excited. So don't be shy. Thanks, Pat.
I love that. Yep. Happy New Year.